We are looking at another day of extreme volatility.
All three of Wall Street's major indexes plunged more than 7% on Monday. The Dow's more than 2,000-point drop is a one-day record.
The stock market just opened and it just closed. Within 30 seconds, the Dow had dropped and the S&P 500 had dropped below their trading limit.
These are certainly scary times in more ways than one. As the stock market reels and the nation locks down to help slow the spread of global pandemic, the question becomes, what can you do to protect yourself as well as your financial future? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. Welcome to the special episode of The Income Generation devoted to the coronavirus outbreak and what it may mean for the economy, the financial markets, and potentially your retirement plan. Now, if you're a regular viewer, you know that based on historical evidence, I believe the stock market is long overdue for a major correction of between 40 and 70%. Is the coronavirus the tipping point that has triggered that actual correction? Will it coincide with another great recession or even depression? And how might all of this ultimately impact your savings and investment portfolio? Depending upon the financial strategies you're using, we're going to examine those questions and many others right here on today's show. We'll put all of today's market madness into historical perspective and also share some good and hopeful news that you should know about right now in these troubling times. We're going to be talking to economist, market forecaster, and editor of the Gloom, Boom, and Doom Report, Dr. Marc Faber.
I've been in business for 50 years. I've never seen a situation where the economy just shuts down.
But first, I want to bring in our co-host for today. Today's the day to have all hands on deck with what the markets are doing. So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, a retirement income store in Melbourne, Florida, and also the brand ambassador for the retirement income store. Jeff, do you think there's a soul alive today who actually can predict what the outcome of this coronavirus pandemic is going to be, economically speaking?
Well, the estimate this morning, Dave, was about $4 trillion of corporate losses if this thing goes out to around 18 months. And that's a real scary number. That means we're going to have a multi-trillion-dollar stimulus over a certain part of time. And like in 2008, when we saw the bailout of the financial industry and banks and institutions, we may have to bail out corporate America.
So Congress, I mean, is Congress politically prepared to do this?
Well, it appears that they are politically prepared to do this. They are uniting for the first time, and it's unfortunate that it takes a pandemic of potentially biblical emphasis here for them to get together and work together.
You know, it's interesting that the hardest part, as you are well aware, is nobody knows how long this is going to last. And if it's really, it's because we have economic stoppage. It's not even a slowdown, it's economic stoppage. So if the stoppage is for 6 weeks and then we open things up and start to come back, that's one thing. If it becomes 18 months, which is the other extreme, then that's a whole other can of worms. So, let's talk about this. How do you see this playing out?
I'm with you. The 6-week stoppage sounds so much better, but it doesn't seem like we're going to get there unless we take the same measures that China made and the same measures that South Korea made. And, China's back to work. The kids are back in school. They shut down the country for 5 weeks. And so what we really need to do is shut down all borders globally for 30 days and make everybody stay at home until this virus runs its course. If we don't do that, this thing is going to drag on. And, the lack of, you can't stop an economy and go right from growth to depression/recession. That's never happened before, Dave.
It's never happened before, but That's basically what we're in risk of right now, is this stoppage. We yet have to see if the spread of the virus in China starts taking off again. As you and I have discussed privately, if it doesn't start taking off again in China, then maybe a total closure for 6 or 8 weeks and then back to somewhat normal is okay. But if their outbreak numbers start to increase, then we're not going to be able to get away with that. Because, at the end of the day, this is, as you know, Jeff, this is simple math, right? I mean, anything that has exponential math, where things grow exponentially, really starts to take off and gets away from us. The whole example about how if you start with a penny and you double it, you have 2, and then you start 2, you go to 4, and then you go to 8, and then you go to 16, and before you know it, you're at $1,000 and you're doubling it, you're going to 2,000, and it just grows exponentially. So the real cure, it seems, is if we literally shut everything down and keep it shut down, like Italy did short term, like China did short term. We haven't done it yet, and keep it shut down until we have a vaccination. That's the only way we can be 100% sure that we're retarding the spread. Is it not?
Well, there's no doubt that's the only way we can pretty much shut the virus down. I mean, we've got to stop it in its tracks, and we have to stop spread. And like you said, exponentially, 2 turns into 4, 4 turns into 16, and so on and so on. And so, but if we look at Europe as the outlier here, Italy's cases are still exploding and they're on lockdown. And so it almost appears that, not to be alarmist here, Dave, but it almost appears that Europe has a different strain than what's in the United States and then what's in China and the rest of Asia. Either that, or they just did a really bad job, and those exponential numbers got out of control, like you had said prior to. So if we can get a hold of this thing, we see 6 weeks of pain, but if this thing lasts 12 to 18 months, I would look for $4 trillion of losses in corporate America, and then the potential for not just a corporate problem or an earnings problem, but a bailout issue. We're going to talk depression then if that happens.
Well, speaking of depression, you heard Mnuchin come out and say that if Congress doesn't get involved, we could have a Great Depression type unemployment rates exceeding 20%. If that happens, then your $4 trillion estimate is probably right on the money. It might even be low. So, I guess what we got to think about is what are the odds really that Congress is going to get together and going to figure out the right solution? Because I think that's necessary to prevent a depression.
Well, I think Congress is doing not enough. We need to have more restrictive measures in terms of how we can box this virus in and get our economy back up. And we have to have them extremely restrictive, because what my fear for China is that we could see a boomerang effect where the virus peaked, then it ascended, and now it's rising back up. And if that happens, then we have no choice globally. But we need a multilateral, a multinational, a multi-global approach to this attack on this virus, because it's in 175 countries and it's going to affect everybody's economy. The economies are virtually just going to stop. And so we've never been in a position where that's happened before. And so we're going to see, massive small business failures. I don't know how the governments of the world, and even Congress, can bail out everybody, and what the filtering mechanism is going to be. They want to get paychecks out here to everybody for 2 or 3 weeks to pay rent, and foreclosures have been suspended as well as evictions. But, I don't know how long that can go on for. This could go on for many more months.
Whatever Congress tries to put through to help small businesses is going to be really sloppy and really hard to implement in the real world. That's the problem. And, because we're so politically correct here in the United States, the issue also is we're unlikely to accept draconian measures like what they had in China and what they have in Italy, where literally, you've got to get a permit to leave the house. If you're walking around without the permit, 1 person per household can leave at a time. If you're walking around without the permit, you get arrested. In China, they try to enforce it with drones. In Italy, they try to enforce it with actual people walking around. Assuming we're too politically correct to take those, quote, draconian measures, then it could get worse. But this is I don't know if you consider 2008 to be a black swan event or not. I'd like to get your take on that. But for me, it's as close as we've come. But I look at a black swan event as truly being something that's really an act of God. And 2008 was created by mankind. It was all about the financial industry, one industry. But this is the first black swan event that really we've ever seen or had to deal with it. Is it not? Do you agree?
Oh, I completely agree. You've nailed it. You're right on point. The difference is it's very eerily similar to the 2008 credit crisis, where we had massive potential for institutional failure and the too big to fail banks, combined with a pandemic flare. You and I couldn't write this on our most creative day if we were prosing the best financial fiction that we could deduct. There's no way you and I could develop this script. This truly is a black swan in every sense.
Yep, it is. It is. Jeff, let's go ahead. We got Marc Faber standing by. Let's go ahead and let's see what Marc Faber has to say about the economy.
We're falling off a cliff, and don't believe for a second officials who tell you, oh, there is a possibility that we go into recession. We are in recession now. We are not in recession. It's a depression. Step out and walk through the street. Tell me how it looks like. In the Depression, at least, you still could drink. There was prohibition, but everywhere there were speakeasies. Now, everything is shut down.
So how long do you think we could go in economic stoppage due to all the isolation that we're all doing because of the coronavirus? How long do you think we can do that before things really, really elongate and get even worse? You think a 6-month stoppage, 6-week stoppage? You think a 4-month stoppage? What can we weather versus what can we not weather, reasonably speaking?
Well, as you know, they have a fiscal stimulus in discussion of $1.2 trillion. I happen to think they will need $1.2 trillion every month. It's going to be very bad. I'm telling you, I've been in business for 50 years. I've never seen a situation where the economy just shut down.
Marc, we need to take a quick commercial break, so we need to leave it right there for now. And you stay with us too. We'll be back here in a moment, coming up on the Income Generation. We'll be right back.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
Welcome back to the Income Generation. I'm David Scranton, and I'm here today with our co-host, Jeff Small, president of Arbor Financial Group in Melbourne, Florida, and also a Retirement Income Store franchisee, as well as our brand ambassador. And Jeff, you heard Marc Faber, and I can't believe it, but for the first time, you sound as pessimistic as Marc Faber on the economy and the stock market. Tell me about the stock market part. We talked about the economy. Tell me about the stock market part and why you're pessimistic from that standpoint.
Well, I think we've witnessed the largest systematic repricing of stock market values in history that parallels the Great Depression. But right now, that mispricing has caused the biggest bear trap in United States history, the biggest one, and the bear is stuck in the trap, and it has something worse than the virus because we have so much more room to fall. We're only down 35%. We're going to fall a lot more, Dave.
Well, and it's funny because you're right. So far it's mispriced. I mean, right now the market has dropped more than the degree to which the economy has slowed down. But the markets are forward-looking, so that's why they're overreacting. They're trying, of course, to figure out what's going to happen in the future. But if you think about it, yeah, we've had some recent restaurant and bar closures and things like that. But also, Jeff, have you gone to the stores? I mean, gosh, when our gym closed, Teresa went to the store to try to get a couple of dumbbells just to work out at home. And literally every last treadmill, every last bench, every last weight, every last piece of equipment was being loaded in the back of somebody's truck as if, they're planning to have to work out from home for 6 months or more. You've seen the shelves. You go to the big Costco's and BJ's, you've seen the shelves. They're empty. People are hoarding everything. So right now, the economic numbers shouldn't look that bad if we could stop it as of today. But yet, we've had the single fastest stock market drop in history in this short period of time. And of course, that's because the markets are trying to forward look and guess how bad it's going to be. So how bad do you think the stock market's going to get?
Well, I think you're right about the market repricing where earnings are going to be, because stock prices are only based on a company's bottom line and what they earn as profit. But I think that the market, Dave, is pricing in a pandemic. It's pricing in a pandemic, and it doesn't know how bad that pandemic is going to be. But the news is getting worse and worse every day. And the last couple of days, we've seen the most distressed panic selling since the Great Depression, in my opinion. And so I think that's going to continue as the headlines get worse and the virus progresses, and we really discover that there are millions of people globally with this virus. And the measures that we're going to have to take into place, I think we could test the March 2009 lows of 676 on the S&P. We're talking about beyond a full reversion to the long-term asset price averages. We're talking about something that's an 80, 90% drop potentially. So as the news gets worse, we will follow that highway to depricing or devolving here in terms of our asset base.
Well, I can't wait to get Marc's feedback on where he thinks the market's going to go. But I agree, we're looking at least 50%, really getting below, I guess 55% would get us below the previous top levels from 2000, 2007, and 2013. Those are the levels that you and I have repeatedly talked about. We have to break below those, or otherwise we're essentially breaking three world records regarding the stock market that have held for 2 centuries now. But what you're saying is right, that we can not only get below 1550 or so, those glass ceilings, but we can also get down to the bottom from the financial crisis. And you're right, that would be over an 80% drop.
If we have $4 trillion of corporate losses, Dave, we will hit sub 1,000 on the S&P. That will happen. And the market is paralleling the headline every day. So we're trading on headlines right now. We don't have the raw economic data. And today, at today's prices, technically, if there's going to be massive losses, the stock market could be dramatically overpriced, even with a 35% correction. And so there's no bearing right now. But with each passing headline, we take one leg south.
Yeah, and what I see happening is typical recessionary spiral effect is all of a sudden now a lot of hourly workers are not working. So now they're not going to be out spending as much money on goods and services because they can't. Eventually, if this lasts longer, maybe not even that much longer, eventually there could be pay cuts for salaried workers, some companies 10, 20, 30% across the board, or even some layoffs for salaried workers. So then you get all those workers that really start to say, wow, maybe I can't pay my car loan, my credit card, my mortgage. They start to default. Then banks starting to tighten up credit. The banks tighten up credit. Now, even as things get toward the bottom, now people can't get credit for a mortgage even though a house might be selling for 50% off. That's your classic recessionary spiral that this could lead to if you think it through. And that's when we could see that 70, 80% pullback on the markets. Is that the same rationale you're looking at?
It really is, because the pandemic will cause a loss of cash flow completely. Companies will start circling the wagons, and they'll start furloughing or laying off employees. And whether we believe it or not, because we're in culture shock here financially from this rapid decline and what's happening with the virus so quickly, that's already happening. The airline industry is furloughing tens of thousands of pilots by cutting back 80% of the flights. But that's just not happening here domestically. That's happening globally. And there's many other industries that are going to be dramatically affected. So if you don't have cash flow, you can't pay your employees. And so what are companies going to do? They're not going to spend all their capital. They're not going to borrow more money to pay people. They're going to start laying people off and circling the wagons. And so as this transcends and evolves, we're going to see depression-like unemployment in this country potentially, unless there's a massive bailout and the greatest handing of free money to corporate America in history.
Bernie Sanders, here we come. It's funny, you and I always try to wonder what the tipping point would be for the next bear market, and I think we may have found it. Let's ask Marc Faber. Let's see what he thinks about where the stock market might head.
Well, it's like Grand Canyon. You go very deep when you walk down. And how low the stock market will go? Well, some stocks have already been hit very hard and may be in the process of bottoming. And also we're very oversold right now. So we may have a rebound of 20%. But I think, economically speaking, we're going down a valley. And the valley is U-shaped. In other words, we can't even see across the valley. And we need to be patient. We had an 11 years bull market. Do you think the bull market is all corrected in 3 months or 1 month?
Not at all.
It takes 2 years.
Exactly, and that's where, and I would agree. So you're saying 2 years where things really start coming around. Great. So do you think at the end of the day, from the peak of the market back in February, do you think that the market overall, let's say the S&P 500, will be down more than or less than 50%? What's your best educated guess?
I think the S&P will be down at least 50%. But 70% would not surprise me.
Okay. All right. I thought you might say that.
I don't like it because I also own shares and I own bonds and so forth. But this is now a setback in markets that is brought about by deleveraging. And we have a credit implosion and everything is going down. Until recently, treasuries were rallying. But on the government intervention, they're now also selling off. They're 15% of the highs.
Marc, we need to take a quick commercial break, so we need to leave it right there for now. And you stay with us too. We'll be back here in a moment, coming up on the Income Generation. We'll be right back. Did you know that the Retirement Income Store publishes its own newsletter? Each month, we share helpful information, research reports, and other resources to help you navigate the complexities of planning and saving for retirement. And for a limited time, we're offering a 3-month trial subscription to the Retirement Income Store newsletter. Visit theretirementincomestore.com to learn more. Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan. Welcome back to the Income Generation. I'm David Scranton. We're here today with co-host Jeff Small, president of Arbor Financial Services, a retirement income store right in Melbourne, Florida, author of the best-selling book, Turning Financial Planning Right Side Up, and also the Retirement Income Store's brand ambassador. So, Jeff, it sounds like Marc agrees with us, as you just heard, that about the market drop being over 50%. He was a little non-committal, so I wanted to kind of push him on that, and I kind of thought he'd think it's perhaps 50% or more. So he agrees it's a tipping point. And you and I always talk about this, that tipping points have several things in common. First of all, they typically come out of left field, right? This came right out of left field. Nobody saw this coming until maybe some in January, if they're really watching what was going on in China. Number two, it's always a newsworthy item when you have a tipping point that causes the market to go from a rapid growth rate to a rapid decline. Obviously, we're talking about it, everybody else is talking about it on the news, It's newsworthy. Next, most of the time it has a humanitarian impact. And this certainly has a humanitarian impact, not just a market impact. Just like when 9/11 occurred, that was a humanitarian impact. And lastly, it's got to have huge economic fallout. And this has all of those things. So the Fed, tell me about what the Fed's done, and you think the Fed's taken the right measures? Is it too much? Is it not enough? Let's talk about that.
Well, I think the Fed is doing everything it can. We've never seen a 125 basis point rate cut on a Sunday in history like they did last Sunday or this past Sunday, and announcing hundreds of billions, I think 500 billion of stimulus and many more billions of stimulus the week before, actually trillions, 1.7 trillion the week before. So whatever the Fed does, the market doesn't seem to be affected by it because the Fed really can't force consumers to get out and spend when they have to be trapped in their house, Dave, because consumers are 70% of the economy. And so if the Fed lowers rates, if the Fed starts giving away free money, that's not going to do anything for anybody. What's that going to do? They're trapped at home.
Yeah, I agree. And it's funny because the consumer was what had this blow-off top in the stock market through December and January and part of February. It's blow-off top that we call it, which is that huge exponential increase in the market right before it starts coming down. And that was all due to consumer spending. That's how all the talking heads on Wall Street were justifying it. So, and for our viewers, it's kind of funny because with all stuff going on financially, Jeff and I have been straight out as well as a lot of other people in the financial industry. So Sunday, he and I decided to take just a quick break and get in a boat and go offshore and go fishing. And we come back Sunday night and bam, here we have the news that the Fed is making these drastic measures. The futures open down. So, immediately it's like you got your Grundens on and you're going right back into analysis mode, looking at what's going to happen on Monday. And of course, we all saw Monday as a huge fall off. The one thing I would say, though, is this. I think the quantitative easing, the 500 million, or 700 million, if you count other things, of quantitative easing, QE, I think is overkill for the reasons you mentioned. I agree with you completely, Jeff. However, the Fed funds rate dropping, that also has a little bit of another effect, and that is to keep the banking plumbing system going. And like Teresa just yesterday walked into the bank and she said there was 15 cars in line for ATMs in the middle of the day. 15 cars. So it's almost like, to some degree, there's some people now that are making a run on the bank to hoard cash. And that's the type of thing that the federal funds rate actually helped. Is it not?
Well, I think it helps, but it's not going to stem the consumer demand to liquidate assets. I mean, Charles Schwab just closed all of their retail operations. JP Morgan just shut down 1,000 branches because there's a run. And so banks really only have about 10%, retail banks in consumer land only have about 10% of their deposits in cash in any one given moment. It's usually less than that. And so if there's a run on the banks, I mean, where's all that cash going to come from as people kind of hunker down and decide to, like Teresa said, she saw these people at the bank, and it's the same thing that's happening in the stores and the same thing that's happening in the banks. And, the Fed can lower rates all they want, but until they start putting checks in the mail, that's not going to fix things.
So has the Fed, in your opinion, shot all their bullets now, and they don't have ammunition to really recover from a recession like they did in the past? And is there only ammunition going to negative interest rates in this country?
Well, the Fed didn't shoot an ammunition. They shot a nuclear bomb of stimulus, and the market just smiled on it and just kept falling. And the consumers started doing what they wanted to do. So until we contain this thing, all that stimulus is not going to do anything until we can go 30 days to 45 days of complete self-containment and lockdown globally as a global effort to curtail this thing. And then maybe we can get back to business and isolate this virus through the community spread component. And that stimulus will help. But with all this stimulus, why is the Fed doing all the stimulus, Dave? They're doing all the stimulus because they want to keep asset prices high. They don't want asset prices to collapse because that's what supports our economy, our household net worth, the stress test of our largest institutions can be met. And so, but that collapse is going to happen until we can get the consumers out spending again.
Yeah. Hey, I want to take a minute and ask Marc Faber what he thinks about the Fed's action and interest rates. And then we come back after the break. We're going to talk about what our viewers can do to protect themselves, what they should do and shouldn't do. But right now, let's get back to Marc Faber. But Marc, how about the most recent move where Fed funds rates got lowered to 0? And then on top of that, they said there's $700 billion of quantitative easing that we're going to be doing. How about that last move in light of the coronavirus crisis? Do you think that was the right move? Do you think it was too little or too much?
In my view, it is too much. And if you think clearly, we have a trigger, the coronavirus. The Fed's action will not solve the corona problem. You understand?
They're treating the symptom, not the problem, 100%.
Yes, so what they can do is solve some symptoms of the financial markets that were jittery. In other words, the market went down. But when you think about it, one of the problems of the recovery after 2008 is that as interest rates were kept low for a very long time and because of QE, leverage built up and zombie companies were kept alive. The companies and countries that should have gone bust at that time.
So let me ask you this then, because it seems like, to me at least, like lowering the Fed funds rates to 0 actually has a purpose, not just to stimulate the economy, but also keeping the financial system, the banking system from getting all gunked up. But as far as the quantitative easing is concerned, I totally agree. That's not going to help the financial system from getting gunked up. And if people are too afraid and don't want to spend, they're not going to spend just because the government floods the economy with money. Am I missing something, or are you in agreement with that?
No, you're correct. If you are not allowed to go out, if your corner bar or pub is closed, you can't spend. And also, people don't realize small businessmen who, in America and elsewhere, the service economy is huge. In other words, around the financial centers and business centers everywhere, there are hairdresser shops, there are nail polishing shops, tattoo shops, massage parlors, and all this is closing down with stay-at-home policies.
So we need to leave it there for now, Marc. I really appreciate you being back on the show during these crazy, crazy times, and I couldn't think of a better guest. And I do have to confess that 9 months ago, when you told me on this very show that you thought that the Fed was going to start buying equities here in the U.S., I thought that was a little bit over the top. But with what's happened recently, I look back at that interview from 9 months ago and I say, you know what? I think Marc Faber was onto something. So we'll have to wait and see, and I look forward to having you back on the show again, Marc. Thank you.
Yes. Thank you.
And welcome back to The Income Generation. I'm David Scranton. We're here with Jeff Small, president of Arbor Financial Services, a retirement income store right in Melbourne, Florida. Author of the book, Turning Financial Planning Right Side Up, the best-selling book, I might add. And also our very own retirement income store brand ambassador. And Jeff, we're practicing social distancing because I'm in my studio right now and I'm sitting at least 6 feet from my camera. Are you making sure that you're at least 6 feet from your camera in your studio also?
I really am, Dave, and I feel like that's enough distancing. We got about 154 miles between us too, so I think we're covered.
There you have it. So what are our viewers to do in a situation like this? Because, we're talking about what could be the worst case, but it's also possible that 4 or 6 weeks of self-quarantine and we're back, somewhat to normal. It's possible Congress comes out with some really good aid emergency packages that help, and we don't get the worst case scenario. We're talking about if this thing lasts longer, and we're also talking about if Congress can't come up with the right formula, the Fed can't come up with the right formula. So we don't want our viewers to overreact, right? But we also don't want them to panic and sit on their hands if they should take action. So let's briefly start with the audience that's not our typical audience, those that are not members of the income generation, those that are under the age of 50. They might have a lot of their money in the stock market. Stock market's down, roughly 30% or so as of now. What do you think they should do as a general rule?
Dave, what we see today in consumer land here is that people that have money still in the market are now suffering from paralysis from the shock of the drop, and they can't make clear-minded decisions that are going to improve their situation financially. And the biggest trap for consumers today, whether they're under 50 or over 50, is to be overexposed to risk and to rationalize what's going to happen here, because we haven't hit the bottom yet in the markets. We're a long way from it. And so, what we're telling our customers here is that if you have risk exposure, you want to de-risk as soon as possible. Don't worry about buying the dips until we see the virus rates begin to ascend and we start to get some control over this thing, not just domestically, but globally. There's a macro picture here, a new dynamic that we've got to employ to decide what to do with your assets, and that's it.
That's right, a true black swan event. Okay, now just a word from our attorneys. Nothing that Jeff and I say on the show or recommend is a specific recommendation for you. We're talking in general terms because we don't know you on a personal level. And it'd be malpractice for us to make a specific recommendation for you on television without knowing you personally. So at the end of the day, the best plan of action is always to find an experienced financial advisor who's been through the financial crisis in 2008, who specializes in people with your demographic, with your needs. So that having been said, Jeff, I tend to agree for our clients that are members of the income generation, markets are down 30. If you haven't de-risked yet, okay, you pushed your luck a little too far. But now I feel strongly as you do, it's going to get worse before it gets better. So it's not too late to de-risk if you're part of the income generation. But then what do you do with your money? Do you go into bonds and bond-like instruments? Do you put a lot in cash short term? Because, when there's a run on cash, everybody's trying to sell things the last few days. As you know, the stocks came down, and then all of a sudden we saw just a couple days ago a different asset class come down, more fixed income. Because if people can't get cash from one thing because they can't get a good price for it, they're going to sell something else when there's a run for cash. So if they de-risk, what do members of the income generation do?
Well, here's the silver lining, and you nailed it, Dave. Every asset class has failed. Every asset class has dropped, from gold to oil to fixed income to commodities to municipal bonds, to the market. Everything has failed. So everything's on sale. Fixed income is on sale. I haven't seen a better time to get into fixed income than 2010. When we hit the bottom and we started to come back. Now is a great time to redeploy for a yield-centric portfolio that is disconnected and uncorrelated to stock market risk, because those assets will come back when the market comes back, but they'll come back much quicker than the market. The market could take years to come back, and you don't want to get stuck in that, I'm waiting to come back mode, or what we call the catch-up mode that we went through from 2000 to 2007, and then post-2008 to about 2016. You don't want to wait 8 years to recapture your assets. That's the wrong game plan.
I agree, and we come back after the break. I do want to talk about why fixed income normally comes back quicker, and why fixed income, even though it may have bonds and bond-like instruments, as we like to call it on the show all the time, Jeff, why, although they've dropped more than they normally would drop in a garden variety recession, why we think that they're still a more secure position than the stock market. But I would also say that right now having some money in cash isn't a bad idea. That money that you think you might want to put back into the stock market, the riskier assets, when the market hits bottom, keeping some of that in cash right now isn't a bad idea. So as the saying goes, cash can be king. Stay with us. We have to take a commercial break. We'll be right back coming up in just a moment right here on the Income Generation. We'll be right back. Welcome back to the Income Generation. I'm Dave Scranton. I'm here with our co-host, Jeff Small. who is president of Arbor Financial Services, a retirement income store right in Melbourne, Florida, and also the Retirement Income Store's very own brand ambassador. Jeff, I know you've got a lot on your plate these days. Thanks for being here to help me co-host this very important show today.
Dave, it's great to be here. It's refreshing to be able to talk to our viewership and give them some insight into the markets and fixed income. And speaking of fixed income, which really is our wheelhouse and our specialty, we prefer fixed income assets at this stage because there's no real market risk, but there is great income involved in fixed income assets, and things that are bond and bond-like instruments produce a specific rate of income that's level, that's uncorrelated or disconnected from the stock market. And I think as a consumer, Dave, we really want to emphasize, that's really where for folks need to be today, as opposed to be riding the Corona roller coaster in this new Corona economy.
And it's the nice thing is on most of the different instruments included in this thing that we call bonds and bond-like instruments, the dollar amount of the income is fixed, not the percentage. The dollar amount is fixed. So even if the actual bond or bond-like instrument drops in value, the dollar of income stays the same, provided, of course, the company doesn't go bankrupt or default. Now, just to correct you, something you said before, we've seen over the last couple of weeks, even bonds and bond-like instruments drop in value significantly. Not quite as much as the stock market, but we've seen them drop. But even then, why do they typically come back quicker, than your typical common stock in a deep recession?
Well, I think the demand for those will go up as soon as the economy settles and we get back to a more level-headed place and where we are with this potential pandemic here. And so those accelerate.
When people realize it's not a doomsday scenario.
That's right. Liquidity comes quicker back to those markets because they're traditionally safer havens than what we call a risk-oriented environment like the stock markets are risk-based.
And also bonds and bond-like instruments have a par value. They have a value that has to be paid back at some time unless the company goes bankrupt. Whereas stocks have a par value when they're issued, but unless you're an accountant auditing the books, par value means nothing after an IPO occurs on a stock. So stocks can go down, and when you lose money in a stock, I love brokers who love to say it's a paper loss. Well, no, it's an actual loss. There's no guarantee it's going to come back. With a bond or bond-like instrument, it truly is a paper loss because eventually that company, if they don't go bankrupt, has to pay it back, and they have to pay back the full par value. And that's also why things will come back quicker typically in the income world than in the growth world. Jeff, we need to leave it there for this segment as we take commercial break, come back to close up the show. Thanks so much for your insights.
Thank you, Dave.
Stay with us. We'll be back in a moment. Coming up on the income generation. We'll be right back. I'd like to take this opportunity to thank Marc Faber for joining us today, and also Jeff Small for being my co-host on this special edition of the Income Generation. Most importantly, though, I want to thank you, our new and returning viewers. As Americans, we've been through plenty of tough times before. We've survived them all, and we will also survive the coronavirus pandemic, just as we did the influenza outbreak of 1918, the Great Depression, World War II, and the financial crisis of 2008. But it's not going to be pleasant. Each day, the humanitarian economic toll from this crisis grows, and undoubtedly, the worst is still to come. With this in mind, I want to urge all of you to stay safe and take the right steps to protect yourself and your loved ones, both from a health perspective as well as from a financial perspective. Health-wise, of course, it means staying up to date on all the latest news and information and following recommended guidelines around social distancing and other precautions. Financially speaking, it means understanding how the economy and all the financial markets are being impacted and what that may mean for your individual retirement plan. Depending upon your goals as well as your stage in life, you may want to take action fast to better protect your assets, ideally by speaking with a financial advisor who specializes, if you're part of the income generation, in strategies geared toward protection and income. In my experience, investing for income is an ideal choice for most people in or nearing retirement, regardless of market conditions. And this is for many reasons. But here are the two of the most important. As we discussed, once you pass the age of 50 or so, you increasingly have less time to make up for a major financial loss. Be aware that whenever a major correction occurs in a long-term secular bear market cycle, it typically takes 6 to 7 years just to get back to its previous peak. That means if you're 58 years old today, you'll be 65 by the time you've recouped the savings that you have now. When you factor in inflation, the question becomes, will that be enough to retire on by then? Or will you have to keep working at least another 7 years after that? Secondarily, most people in or nearing retirement have income-based goals. They're not looking to achieve massive growth in order to fund a major purchase or to leave a huge inheritance. Rather, they're looking to protect their savings while achieving reasonable growth and, most importantly, reliable income to meet their needs and to enjoy your retirement years with confidence, with peace of mind. Let's face it, we could all use a little more peace of mind these days, and that's really what investing for income is designed for. Thanks for watching. If you're close to retirement and really want to know how to protect and maximize your money, it's essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.